Hi everyone, welcome to this investment update. I'm Nick Moles, I'm the Head of Marketing at Wren Sterling, and I've been joined by John Moore of Brewin Dolphin. Brewin Dolphin are part of Wren Sterling's panel of investment managers, and they've kindly agreed to give Wren Sterling's clients their view of what is happening in the market at the moment and what historic investment performance can tell today's investors. So John, I'll hand over to you to introduce yourself and begin the presentation.
Thank you, Nick. I'm John Moore. I'm a Senior Investment Manager at Brewin Dolphin. I've been with Brewin Dolphin since 1992, so I've got quite a range of experience, and I'm hoping to share some of that experience and some of that thought process with you all today. And as part of that, I thought it would be helpful really to start off by looking at some of the things that have already happened and review that and give some idea about what has happened, where we are today, and what might happen in the weeks and months that are ahead, and how we should sort of think about that. So to start with, first of all, we'll go through the disclaimer and the things that are caveats that you should be aware of. Please take note of those. To start with, this crisis started really in China, and one of the sort of key points that you could see the crisis through quite clearly was the oil price. And the oil market is one of the few markets where supply and demand really shows through in terms of price. So China, a very large user of oil, and you know, as a manufacturing sector, the oil price started to reflect the fact that China was slowing down and closing down in early points. That then was accelerated in terms of the oil price moves when Saudi Arabia and Russia got into a bit of a battle about supply and what should happen next. And you can see that here in the chart in front of us. So the oil price has been very much at the vanguard of this movement that we've had to do with the coronavirus and so on. And I thought this chart was a very helpful way to show that. Moving on to closer to home, the UK stock market, and in particular the FTSE 100, which is the largest 100 companies in the UK, you know, that's dominated by oil companies. BP and Shell are two of our largest companies in the FTSE 100 listed in the stock market. So given what we've just mentioned with regard to the oil price, it's perhaps no surprise to see that the oil price has an impact on those stocks and had an impact on the FTSE 100 as well. And you can see that movement here. Away from the FTSE 100 being the population of oil companies like BP and Shell, you also have companies like Lloyd's, insurance companies like Prudential and Legal and General. And as this crisis has developed, what you've seen is the Prudential Regulatory Authority, the Bank of England, have encouraged those companies to stop paying dividends and to think about the financial resources as we go through this very extraordinary period that we're in. So that's also had an impact on the FTSE 100's performance and some of the more recent volatility. Moving on to look at the FTSE 250, that is the home of the next 250 largest companies within the UK. Typically, it's much more domestically orientated than the FTSE 100. So within here, you're looking at house builders such as Bellway, you're looking at retailers such as Marks and Spencer, and so on, Boohoo. You're looking at transport companies like National Express and Stagecoach. And similarly, you've had a big drawdown in terms of the way that markets have performed, but for very different reasons. And those reasons are very much to do with specifically the lockdown, the shutdown in activity, and the impact that that has had on those businesses, those very domestically sensitive businesses. So a different path, quite a similar outcome, but a different path for the FTSE 250. Moving away from our island and our stock markets, America is best represented by the S&P 500, and yes, as you can see from this chart here, there's been a decline in value in the S&P 500 since the coronavirus started to take hold and became a global phenomenon. But what you can see is that the S&P 500 has been much more resilient than the UK market and many other stock markets around the world. Why might that be the case? if you think about the makeup of the US stock market, that is a not insignificant factor in this period. 27-28% of the US stock market is technology companies, well-recognized names such as Netflix and Microsoft, Google, Amazon, Facebook. Many of these companies might be seen as beneficiaries of the work from home and stay at home, and our business is very much using Microsoft, for example, as part of our work from home plan. So the US stock market has had volatility, it has had declines, but the pace of decline has been much lighter than is the case elsewhere, probably mostly because of that technology bias that they have, more exposure to things like biotechnology and healthcare, and companies like Gilead, who last night announced that they may well have a cure for or some treatment for COVID-19. In a crisis, we often look to what represents the fear of that crisis, and gold is often seen as a currency by many, and it's a currency of fear. When people have fear, they often run to things like gold and cash, and it's a safe haven against monetary policy, against uncertainty. And as you can see from this chart, that fear index has increased. The value of gold in dollar terms, the currency it typically trades in, has increased as people have become much more uncertain about the economic value of companies, of bonds, of property and other assets. So it's been a good crisis for gold thus far. All crises tend to be pretty good for gold, and this one is indeed no different. I wanted to take a step back and look at history, really. We've been here before, and it's often good to try and reflect on what you've learned from previous downturns, what you've learned from previous crises, because although past performance isn't a guide to the future, as a regulator often talks about, there are things that are similar, there are parallels you can draw from previous crises. And when I started in 1992, the imagery of 1987 was very much in my colleagues' mind at that point in time. They kept telling you stories of the crash of 87, of the weatherman saying there wasn't any hurricane or any winds coming. All of those sort of things were very clear in people's mind, and that was one of the sort of formative things at the start of my career. Another was, if I think back to when I was born in the 70s, my father invested in a unit trust right at that point in time, and during the oil crisis of 72 to 74 sold and bought some premium bonds, and I've got a lovely certificate showing £150 worth of premium bonds. £150 in 1974 would have been probably quite a lot of money. It's not so much money today, and the chart that I've got here in front shows you really a long-term chart of performance of, say, the UK stock market against cash. And this isn't to say that the answer is always investments and shares. It's to provide a little bit of context about the past. And it's worthwhile going back to what I said at the start, 1987, that formative crash for me at the start of my career, and for many of my colleagues. It's that very small bump at the start of this chart. It's almost unrecognisable, and it took time to get through that period. It took a lot of patience to get much ahead of that period, but what we can see from history is that these things do pass, and you do get sort of periods where, if you're patient, that patience for remaining invested in the balance of investments that you have, that patience is often rewarded over a period of time. And that's why it's important when you're dealing with Wren Sterling, and that you've got that good balance of investments, that good balance of savings that you've got there, that allows you that patience, that allows you the chance to participate in this sort of long-term trend, the trend that we believe is really your friend. So, I think a lot of what we look at conditions us to past crises, and it allows us to be armed for future crises and future moves as well. So what I wanted to move on to now is to show you, I guess, probably taking a step back, what other things did I think about in past crises, and what other things did we learn from past crises? And what we've got here are 4 picture slides that I'm just going to talk you through. The first is 1987. I talked a little bit about that earlier on. But in 1987, you had an open outcry stock market. You had lots of pictures like you can see here of people running about and buying and selling and shouting and so on. If you were to take a step back, technology has changed. And there's constant change, and often that's accelerated at points like a crisis. If you move forward to 2000, the TMT was the big excitement. It was perhaps the bubble. The crisis at that point in time was show me the money. There was no profitability in those businesses, and therefore their sustainability was not immediate at that point in time. You then fast forward to 2008, and in the middle of the global financial crisis, the response to that from lots of individuals was change, once again. But that change was, lower prices, greater customer experience, better outcomes, quicker, faster, cheaper. And Amazon was a great beneficiary of that period of change. Here we are today, 2020. We're going through, again, another crisis, but I believe we'll also go through another period of change. And things do evolve, things do change. So whilst we're in a crisis like this, it's hard to see the wood from the trees, but what past crises have shown us is that things evolve and things move on. And it's interesting that 20 years ago there was a TMT crisis. There was no profitability in technology stocks then. Now it's those technology stocks that have got the cash flow, the profitability, that are the key unique utilities for us to work from home and do what we do. So things change, but that change is a positive thing. That change is a very positive thing. I wanted now to look forward and see, what might we expect reasonably as we sort of view the future. And as I'm speaking to you, we don't really have any sort of playbook for how we return to normality, how we return to work in any shape or form, how we return to what we recognised as the normal life last year. So I have to caveat everything that you will see here by saying that it is today's estimates, and therefore the passing of time may or may not be kind to those. But what you can see here is the IMF's view of what will happen to GDP, gross domestic product, and as you can see here, the movement that is estimated at this point in time is what we call a V-shaped recovery. That seems to be consistent with what a lot of people view as being a very specific, very event-driven scenario. So it was something that was imposed on us quickly, therefore perhaps it's something that we'll be able to recover from quickly. And that's certainly the consensus looking at the IMF statistics. And that's also what they're viewing in terms of earnings per share forecasts. What we don't have here, which we do in the GDP forecast, is we don't have a view of how the movements in GDP will go to in terms of earnings per share. We can see the downturn, but we can't see how quickly the recovery is. And that's probably because it's going to be case by case, company by company. To my point that I made earlier, some businesses will thrive in change, some businesses will be challenged by change. If I go back to my experience when I walked in the door in 1992, the UK stock market was populated by companies such as Lucas Varity, Blue Circle Industries, BOC. Those businesses just don't exist just now. So they've been changed, they've been taken over, other things have moved on. So we're in a period of change, and this environment will lead to change. The strong will get stronger, and the weak will have to make some very difficult decisions in terms of how they change their business and change their balance sheet to move forward. I thought, before I hand back to Nick, what I thought I would do is just talk over some quotes, some sort of inspiration that might help you to get a little bit of reassurance to remain in the market. this gentleman here is Aswath Damodaran, and he is a professor of finance at STEM Business School, and he's sort of widely seen as an expert in equity and private equity valuation. One of the things that he said, and which I think is very interesting, very telling for today, is perspective. Perspective is the first casualty in a crisis, and I think that's a very interesting thing to make a point of, is that we're in the white heat of this crisis at present, and it's very difficult to try and work out what happens next. As humans, we often put a lot of value on the stress today, and we sometimes struggle to plan out what happens in future. And I think that's very relevant in this current crisis, because we just don't know individually what happens next. And I think that's something that's challenging, but I would be optimistic about that. And in doing so, I want to pass on to my next quote, next piece of hopeful inspiration for you. This is Eleanor Roosevelt. She was the First Lady to the 36th President, and someone who lived through the Great Depression. Now, I don't think this period is like that, despite what people have said and the parallels that people may draw. But she did live through that very challenging period, and one of the quotes that she said, which I find inspirational, is, a stumbling block for the pessimist is a stepping stone for the optimist. And again, it's that idea of change. What's in front of you? How do you react to that? How do you change to that? And I think that spirit of the optimism has tended to typically drive economies forward and markets forward and businesses forward, and therefore assets forward. So that's the sort of optimism that I suspect not today, but in time might be rewarded. Finally, it's hard not to sort of look at quotes and so on without coming back to Warren Buffett, and he is the sort of master of investment markets. He's well recognised, he's well quoted, lots of books about him, and if you have time, I would really recommend that you read the Berkshire Hathaway newsletters on that website. You can see all the newsletters going back into the 60s and 70s, so it's a great read. But two quotes that are interesting and relevant, I think, for this talk. The first would be, the time to be fearful is when others are greedy, and the time to be greedy is when others are fearful, and that seems quite primal, but I guess what he's really trying to say is, this is a time to be optimistic, not pessimistic. Better times will be ahead. And perhaps an easier way to say that is that another quote, less well known, is that he often said, someone is sitting in the shade today because someone else planted a tree a long time ago. And that's the sort of key to investment, is it's about patience, it's about forward thinking, and it's about trying to maintain that during periods of stress and noise like we have got today. So in summary, I hope that's been a helpful run through of investment markets. I'll finish off, Nick, with another disclaimer just to make sure that everybody's aware of some of the important things that are here, and in particular, past performance is no guide to the future. But Nick, I'm going to pass back over to you, and thank you for the opportunity to speak today.
John, thank you very much for that presentation. I think the kind of information you've imparted there is definitely exactly what people need to be hearing. It's that long-term perspective, bearing in mind that investing is something that will suffer fluctuations along the way, but it's the destination rather than the journey itself. That's the end of our presentation today. I hope you enjoyed it, and thanks for joining us.